I'm Grant Walker. Welcome to Heads Up for Tuesday the 19th of May. I'll be back with Last Call for you today at 4 p.m. In business news, a newly established annuities provider is equity crowdfunding before it targets retirees dipping into their KiwiSaver funds. The Retirement Income Group, co-founded by former AXA and ACC Chief Executive Ralph Stewart, hopes to raise between $250,000 and $1.24 million at $1 a share on crowdfunding platform Equitise. New Zealanders have started to accumulate substantial amounts of capital since KiwiSaver began 7 years ago, and the 500,000 people reaching 65 over the next 15 years will do so with savings of $36 billion. While individual balances vary, just over half of those 500,000 have incomes of more than $80,000 a year and have been KiwiSaver members since the savings scheme began in 2007. There are currently no New Zealand providers of annuities, which convert lump sum retirement payments into a fixed income stream for as long as a person lives, and typically sold by life insurance companies, after falling out of favour due to their lack of inflation protection, illiquidity and tax disincentives. But private companies such as the Retirement Income Group are starting to take advantage of the decumulation market heating up as KiwiSaver members hit 65 when they can withdraw their funds. The company's flagship annuities-type balance fund product, called the Lifetime Income Fund, will target retirees who want a steady income stream instead of a lump sum when they draw down their savings. The Lifetime Income Fund is awaiting the final stamp of approval from the Reserve Bank, which had to introduce new solvency standards for variable annuities to cover it. This is the first product of its kind in New Zealand, although they're popular overseas, particularly in North America and Japan. The short crowdfunding campaign, there are 3 days left to go, reflects that it forms just part of a capital raise of between 2.25 and 3 million, which has already been 65% funded by wholesale investors. Investments will be used to launch the fund and provide regulatory, working and insurance solvency capital. The company expects to seek a further $3 million of institutional funding in 2017, although it says the exact amount will be determined by how much is raised in this funding round and growth over the next 3 years. The company, currently valued at $10.75 million, expects an exit for investors either through a stock market listing or by being acquired by an international fund manager, bank or insurer. It does not expect to pay dividends in the first 5 years and warns there are risks it will not achieve forecast, including retaining key staff, changing solvency requirements, and new entrants with a competitive product. While you were sleeping, stocks on Wall Street rose, with two main benchmarks nearing all-time highs as the first quarter earnings reports tail off. Other world markets also made modest gains, while gold continued its strong run on fears of Greek sovereign debt default. Oil was steady as Saudi Arabia stepped up production. On Wall Street, the Dow Jones Industrial Average gained 0.1%, the S&P 500 rose 0.2%, and the Nasdaq gained 0.4%. European stocks ended a choppy session as a fresh slide in the euro supported exporters. Germany's DAX ended 1.3% higher, spurring the Stoxx Europe 600 to a 0.4% rise. France's CAC and London's FTSE 100 and other indices in both northern and southern Europe were stronger too. The Stoxx Europe 600 is up more than 16% so far this year, largely thanks to a surge in the dollar during the start of 2015. In Asia, Tokyo stocks neared a 3-week high, helped by a modestly stronger dollar and solid earnings from Japanese financial firms. The Shanghai Composite Index ended 0.6% down, ahead of a slew of initial public offerings expected to soak up cash. In Hong Kong, the Hang Seng Index closed down 0.8% after weak China housing data sunk property developers. Australian shares ended notably lower, led by a sell-off in the financial sector amid concerns about the country's weak economy and overheating housing market. To the WTO, in a setback for strict country of origin labelling, the World Trade Organization has ruled against the US over information on meat packaging. The rule involves a year-long bid by Mexico and Canada to overturn US labelling rules that require meat packers to identify where animals are born, raised and slaughtered. Livestock exporters in Mexico and Canada claim these discriminate against their cattle and pigs, forcing them to accept lower prices. The US has required country of origin labels on its beef, pork and other meat items since 2009. The ruling paves the way for Canada and Mexico to seek retaliatory action against the US. Earlier reports have suggested Canada could place import bans on US meat, wine, chocolate, jewelry and furniture. US cattle ranchers benefit because they receive a premium for their animals born in the US, and they're backed by consumer advocates who say Americans deserve to know where their food comes from. Canada and Mexico say the labelling requirements are discriminatory because meat packers don't want to go through the hassle and expense of segregating imported animals. As a result, meat packers pay lower prices for Canadian and Mexican animals. In 2014, the US imported more than 2 million head of cattle from Canada and Mexico and brought in nearly 5 million pigs from Canada. There's no evidence to suggest that the imported animals pose a health risk. The WTO says country of origin labels impose a disproportionate burden on producers and processors of livestock that cannot be explained by the need to provide origin information to consumers.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
NBR Radio, Monday the 18th. I'm John Stewart. And I'm joined by our political editor, Rob Hosking, on the line from Wellington. Rob takes a look at the week ahead every Monday. So, Rob, we've had a fairly vigorous start to the week with the announcement of this, what appears to be capital gains tax. How do we evaluate this tax?
Well, this has been looked at for a while. It was looked at very, very closely about 5 years ago and then dropped. This is not a capital gains tax, technically. It is a way of taxing capital gains more than they are currently. That doesn't make it a capital gains tax. This is effectively looking at making part of the Income Tax Act a lot clearer around when it does and doesn't apply to gains on the sale of property. Now, it's a section of the income tax that has been there since at least 1956, and I think possibly longer, but I think gone back to previous incarnations of the Income Tax Act. But basically says that, look, if you look like you are buying a property and selling it with the intention of making a capital gain on that property, therefore that capital gain, the gap between the value when you bought it and when you sold it, that difference is part of your assessable income for that tax year, and you'll be taxed on that at whatever your marginal tax rate is. So
effectively it's an income tax rather than a separate capital gains tax?
It's an extension of the Income Tax Act, yes.
Right.
It's making an area which has been very vague for a whole lot of reasons, including the way it's written and also the way courts have interpreted that, because you could interpret the current writing to include the family home, and most people have agreed that's not what was actually meant. And what this is what they talk about, bright lining the test, basically saying we're going to make it clearer by saying that, look, if you're selling it within 2 years, you clearly intended to sell it as a capital gain, therefore it's just going to be automatically part of your income.
Have the courts been fairly consistent in their interpretation of this?
No, they've been all over the place. And to be fair, there haven't been that many cases. What I find interesting is this is an area which the IRD started enforcing more rigorously from around the middle of the last decade, and then in 2007 they were given extra money to enforce it, and then even more money. That amount was doubled in the 2010 budget. Since then it's been raised again. Yesterday's announcement also says we're going to provide even more money to enforce it. What I find really interesting is, despite the intense enforcement that's gone on in this area, there has been not one test case. It's been settled pretty much every time the property investors have basically folded their hands and ponied up.
Yeah, seems like it.
So this means that effectively they're pretty sure of their ground in this area.
Right, and I think I read somewhere that there's an extra $29 million for inspectors to police this.
Yes.
Yep.
And that's quite an increase on the existing budget allocation. So look, they're serious about this. The thing that I find a little, I've got some question marks about is that 2 year time frame. That seems to me very short. And certainly when officials looked at it 5 years ago, they were asked to by the government in 2010 in the run-up to 2010 budget. They basically said 5 years minimum to be meaningful, and the government has decided that might be politically too tricky, so they've gone for 2 years.
So, Rob, why did they dump it as an idea back in 2010?
I think there's a bit of complacency. I think there was also a feeling that other changes they made, because they stopped the ability for property investors to claim depreciation, I think they decided that was enough. I think it was a big mistake, not just for the effect on the property market, but that was a tax reform budget. That was the tax switch, which ministers talk about, where GST was lifted and income tax was lowered, as was company tax. What happened there as well was, or what could have happened there, I should say, is that, like I said, this is an area of the tax law which is quite vague and quite unclear, and it was the opportunity, I think, to just say, listen, we're going to make it a lot clearer. And there was quite a lot of work. I dug out my file yesterday when this announcement came, because I did a lot of Official Information Act requests on it at the time and dug out the paper trail, and there was a lot of work went on about Treasury and IRD on the issue. Now, the IRD didn't like it much, but the Treasury was reasonably keen, because the Treasury wanted a comprehensive, real sort of full-blown capital gains tax, but figured it wasn't going to get it. So this was their sort of plan B, if you like.
Right. What's the Labour Party reaction to this new tax been?
They did a bit of their initial reaction was, aha, it's a capital gains tax after all. And some of them still, Labour's reaction has actually been a little bit uncoordinated. Andrew Little has said correctly that it's not a capital gains tax. Some of his people have said it is. I think the penny dropped that if they called this a capital gains tax and were going, crowing that the government had to introduce one after all, then that would make it more difficult for Labour to introduce a capital gains tax when it gets into government at some point in the future. And they still, although it's under review, it's still very much part of Labour's policy to introduce a capital gains tax. So obviously it was going to be a bit of an own goal to call this a capital gains tax.
Yeah.
I think Andrew Little's quite right when he says, look, this is piecemeal and this is a bit panicky. In fact, I used the term panicky myself yesterday when I Chris Keel and I did a piece for Online. This does look like it's a bit of a they've come rather late to this issue, it has to be said, the government. They really should have done this some time ago.
Yeah. Now, looking ahead to the week, we've got a couple of minutes left, Rob, and we've got the budget coming up. Any surprises, do you think, that we can expect? They've probably dropped the biggest surprise, which was yesterday's announcement.
Well, I'm wondering about that, because you sort of think if you wanted to have this thing to have a big impact, you would normally put it on budget day. And the fact that they put it out yesterday, when it was obviously going to get a lot of coverage, you release something that's on a Sunday, and also anything to do with property and capital gains and tax is going to get a lot of coverage right now.
Yeah.
That to me suggests that there's going to be more to this to Thursday's budget than maybe we were thinking, because otherwise, otherwise, the budget is going to seem a damn squib. I don't think they want it to be a damn squib.
But don't they like to have no surprises these days?
But they don't like to be seen as do nothing either.
Right.
You're right, and that no surprise thing. That is sensible management. The whole sort of thing we used to have, where the Minister of Finance would just get up or go on TV and say, right, there's a midnight tonight, boom. That's no way to run a country. And things are more measured these days. But I think probably more reform in areas around the public service, around social services, getting third party, the third sector involved, voluntary groups, etc., in the social housing area. I think there's probably going to be a bit more around that, that extension of social services into basically getting a lot more voluntary groups and a lot more community organisations delivering social services. I think that's probably going to be more on Thursday afternoon.
Okay, we'll watch those spaces. Thanks very much for your week ahead, Rob.
NBR Radio. With Clooney Restaurant, an unparalleled private dining room choice. NBR Radio.
In business news, Lewis Road Creamery of Whittaker's chocolate milk fame is supporting an initiative to boost the organic dairy sector. Lewis Road is a founding customer of the Organic Dairy Hub Cooperative, which links organic farms with dairy producers. The purpose is to provide certainty of sale for farmers and certainty of supply for buyers. Lewis Road founder Peter Cullinane is one of two independent directors of the hub. He says, since we launched our milks in 2013, we've grown the organic milk category in both volume and value. We love organic farming, he says, and our goal is to make as much of our range as possible organic. However, due to inconsistency of supply, this has been a challenge for us and has meant our organic milk range isn't always available. Lewis Road Creamery's organic milk range has just returned to supermarket shelves after a 2-month absence due to seasonal supply issues. Last week, Fonterra announced it was expanding its organic milk products by making Anchor Organic available in supermarkets and at a more affordable price. Mr. Cullinane says demand for organic is booming here and overseas, yet the number of organic dairy farms has fallen from 125 to 85 in the past 3 years. He says the Organic Dairy Hub Cooperative will help to reverse this trend, shore up supply of organic milk and ensure our customers can enjoy it year-round. Bill Quinn, an organic farmer and the other independent director of the hub, says 33 dairy farms have already signed up. He says over the next 3 years we have a projected 30 million litres of organic milk becoming available, and we know the demand is there, as we've already made arrangements for the sale of most of the milk we will receive next season. Let's update the Saudi gift story. Stuart Nash has hit out at the government's $7.45 million gift of a demonstration farm to the largest livestock trading company in Saudi Arabia, saying the deal lacks transparency. Labour's MP for Napier says this is corporate welfare at its worst. Meanwhile, he says the Hawke's Bay company chosen to develop the farm due to its experience in the Middle East, as claimed by NZTE, has no direct experience of working there. Mr. Nash says of National's decision to pay $6 million to Brownrigg Agriculture to develop a consortium of 30 Kiwi companies to deliver mostly unspecified goods and services for the demonstration farm in Saudi Arabia, giving taxpayer grants to benefit wealthy foreign farmers on the other side of the world is not the way we do business in this country. On completion next month, the farm will be owned and managed by the Al Khalaf Group, which will pocket the future progeny of 900 pregnant ewes that were air freighted at a further cost to New Zealand taxpayers of $1.45 million. Mr. Nash says of allegations the $7 million payment was made to Hamoud Al Ali Khalaf to help facilitate a free trade deal between New Zealand and the Gulf states. Forget the official spin, he says. The real reasons for the so-called investment seem murky, with rumours and accusations of cronyism. What makes the deal even more difficult to swallow, he says, is the absolute lack of transparency surrounding exactly who has received how much money for what and when, and if there is going to be any more of our money transferred to a Middle Eastern bank account. The Labour MP says what we do know as fact, however, is that the taxpayer-funded millions will end up benefiting Mr. Al Khalaf, an extremely wealthy Saudi businessman. It appears many others are also failing to understand the motives behind the $7.45 million splurge. According to an NBR poll, some 40% of respondents say it's utterly incomprehensible for the government to spend $7 million plus on a demo farm in Saudi Arabia. 26% agree with the NZTE's stated reason for the demonstration farm's existence is to showcase New Zealand agri-tech and expertise. 18% of respondents say it's there to help facilitate an FTA with Gulf states, and 16% opting for because corporate welfare is worthwhile.
NBR Radio, Monday the 18th. I'm John Stewart. I'm here with court reporter Victoria Young to discuss bankrupts with KiwiSaver funds. Victoria, there is a test case underway at the moment. Can you tell us what that case is about?
So this test case between the official S&E, who administers bankruptcies, and a trustee firm, Trustees Executors, is actually pretty much at the end of the road. The case was about how Trustees Executors refused to release the KiwiSaver funds of bankrupts to the official S&E so they could be distributed to creditors.
So how many people does it impact?
Well, the reason why it's quite an interesting test case, even though it was only about those two bankrupts, is because, looking at the wider picture, the rule concerns, almost 6,000 bankrupts which have KiwiSaver accounts that total $27.3 million. That's according to the official S&E's estimates in the case.
So what did the High Court say?
So back in the High Court stage, the official S&E said that bankruptcy was a significant financial hardship and therefore there'd be an early release clause for the superannuation funds, which, as we know, are supposed to be set aside until the age of 65. And the High Court agreed with that. However, this went up another level and the Court of Appeal said no, and so made quite a change in the law so that the position was not that superannuation interest passed to the official S&E. So, quite an interesting decision by the Court of Appeal.
So what's the latest development?
Well, while many thought that this would go up to the Supreme Court, our nation's top court, the official S&E has said, no, that's it, we're not appealing or taking this any further. And this has been welcomed by trustees, executors, lawyer, DLA Piper partner Rachel Taylor. And she says it's good because basically it means legislative reform is not needed. Back at the High Court stage, the judge, Justice Ronald Young, had indicated, oh no, we definitely need legislative reform. But obviously as that's been overturned and there's no appeal, this means that, those with KiwiSaver providers and creditors of these people all have the certainty, whether they like the law or not. It's all certain now because it's the end of the road for the case.
Right. Victoria, thank you very much for that.
NBR Radio. With the Property Press. It's out now to show you around.
NBR Radio, Monday the 18th. I'm John Stewart, and I'm here with Jason Walls, our economics reporter, for Market Talk Currencies. And we're joined by Tim Kelleher, who's head of foreign exchange sales for ASB. Now, what's happening with the US dollar, Tim?
Well, some weakness again overnight. The data that came out Friday evening was slightly on the softer side again. So it just reiterates that we think that a movement by the Federal Reserve in June is probably going to be unlikely.
Right.
Yeah, because we were just saying before we were on air here, it's being pushed to September, right?
Well, that's when Janet's doing her testimonial, so you'd assume if they're going to make a rates announcement change, they'd want the chairman talking at the time. So
Yeah. Okay.
there's going to be some major policy change, then it's not going to be a non-announcement meeting.
Yeah, so just for a little bit of background for our listeners here, I mean, US rates are currently at what? Just bone level rate at 0.258.
Yeah,
And
0 to 0.25.
They've been at that level since just after the financial crisis, about 2008, right?
Correct, 6 years.
Yeah. So it's a really, really low level. I mean, when you look at New Zealand, we're at 3.5. And, I mean, historically, that's quite low for us. But on a global scale, it's huge, isn't it?
Yeah, we certainly are standing out, hence why our currency's been so strong for the previous 2 to 3 years.
Yeah. And, I mean, the US currency, I mean, we just saw that it weakened for the 5th straight week in a row against the euro, didn't it?
Yeah, and interestingly, the euro may be more around positioning in the market. The market was extremely short. Every hedge fund was on the trade, so that's probably part of it. The rest of it is probably that we've seen some pretty good numbers out of Germany, even France last week. So we've seen some fairly vicious short covering in the European bond markets as well. So that's probably pushed euro up a little bit as well. So
yeah, because I was writing about it last week. It was the first time since 2010 that all Germany, France, who are the big four? Germany, France, Italy, and Spain have actually had positive GDP growth, hasn't it?
Yeah, so it's first time in a long time. But unfortunately, Greece slipped back into recession.
Greece. It's something that John and I talk about often, don't we, John?
We do.
Yeah,
the basket case.
The basket case. And now we just crazy the other day with they made the IMF payment, but apparently what's been reported is that they just used the emergency funds from the IMF to make this payment.
Yeah, so the word is the Bank of Greece knew about the account. The Alex Tsipras didn't know about it. He'd actually emailed the IMF, said we won't be making the payment. This is 2 days beforehand, so now there's a fair bit of pressure on apparently the chairman of the Bank of Greece to step down.
Oh, really?
Yeah, it would be. So, I mean, we've got the Federal Open Market Committee meeting this week. It's on Friday, correct?
Yes. Friday.
Yes, okay. So what are we expecting? Because always when they release their statements, it's the wording that's important, isn't it? And we're looking for changes in some, like a couple of meetings ago, it was they dropped the word patience.
Yeah, well, it's a tricky one because one would expect they'd want to telegraph an exit, but not make it that they're backed into a corner. So they probably need to surprise the market at some stage. I mean, actually go and not go by 0.25%, go by 0.5%. I mean, realistically, if your rates go from 0.25 to 0.75, it's neither here nor there. So, but as I said, I think June's too early given the poor data and the GDP forecasts have all been slashed. I mean, every year we get a snowmageddon and they forget that it affects the data for the following 3 to 4 months. Yeah. No different this year. So, as I said, June's a stretch. July's obviously out. There's no press conference, so it makes September the most likely one.
Okay. Well, I'm just saying you said that it's not going to the way that it's going to be hiked. You're saying it's going to be 0.5% or a full percent or what?
No, they'll probably go the stock standard 0.25%. I mean, but as I said, if we're sitting here and we're at a 0.5% rate move, I mean, from a 0.25 to 0.75, it's not going to affect your mortgage rate. It's
exactly.
Chicken feed, and they should just get on with the job.
But they'll signal more to come, right?
You would hope so, but they may just go one and done, and that's the problem. So they've got a market, especially an equity market, that is very juiced up on easy money, and I think when we see the move, there will be some downside to those markets.
Now, just looking at the relationship between the US dollar and the euro, they've nearly reached parity at some points. Do you think we actually will see parity between the dollar and the euro?
1.4 at one stage, wasn't it? And that's when sort of the parity discussion erupted. I mean, I saw it on a couple of forums online. I mean, as when New Zealand was very close to Australia, it sort of had the same effect in the US, and was sort of being patriotic about it and say, like, yeah, we're beating Europe. It's a weird sort of thing, isn't it, Tim? That when people say that we're getting close, it's sort of we're beating another country.
Yeah, there's a lot of sentiment involved, I guess.
So, I mean, as you were saying before, we saw a lot of good data coming out of Europe. Well, good retrospectively,
Yeah, so we've had quite a strong squeeze. We're up, 10, 11 euros off those lows. The mumble on the weekend, though, is that the Greeks will be in default by the 5th of June. That's when their next payment is due of 300 million euros. So that came out of an IMF leak on the weekend. So it gives us 2 to 3 weeks to see what goes on. Obviously, they're still negotiating in the background, but June is when the majority of their big payments are due. So I can't see... if they don't get some sort of relief from the ECB, I can't see them making it through mid-June. Yeah,
they've just done a lot of desperate moves. I mean, raiding the pension funds, slapping this 18% tax on tourists and things like that. It's just very desperate times.
Yeah, and so I think the volatility in the euro is going to be there up until that point in time. But as I said, I think a lot of it has been squaring up of market positioning. I mean, hedge funds that never have the trade on have been going, I've been short euro, I've made my money for the year. So it was certainly almost a lay-down misere once the ECB started QE last year.
Right. Now, last week, Graham Wheeler, the Governor of the Reserve Bank, reiterated that he still considered the currency unjustified and unsustainable, which are key criteria for intervention. What impact has this actually had in reality?
Well, I think it's important to note at this point that, I mean, officials have been saying this for a while. I mean, Key came out and said it. I think Wheeler said it before, right?
Yeah. So, I mean, that is one of the 4 pillars of intervention, is the unjustified and unsustainable. So when, during the Financial Stability Review last week, they omitted the word unjustified, we saw quite a vicious bounce in the currency. Now, I don't know whether that was an error. He certainly reinserted it in the afternoon at the Parliamentary Select Committee, but by that point in time, the damage was done.
Yeah.
And so we saw a pretty strong squeeze again that night up through 75 cents. And then we jumped as high as 75.60.
That's against the US, right?
Yeah, against the US, on that retail sales data, which was just, everyone staying at home eating pizza and buying a new big screen TV.
Yeah. Right.
So the currency's come off since then, but it's certainly one of those 4 pillars. So we were surprised, as was the market, when he initially omitted it. And I'm assuming it was an error, not on purpose.
But he's right, though, isn't it? It is unsustainably high.
Well, I think they're probably quite happy with the level of the Kiwi US. Certainly the TWI, which is what they intervene against, the basket of currencies, is what they would like lower. So you've had Kiwi Euro, Kiwi Aussie and Kiwi Yen all quite high, but dropping now.
Okay, thank you very much, gentlemen, for your insights into the currency markets.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
To the WTO, in a setback for strict country of origin labelling, the World Trade Organization has ruled against the US over information on meat packaging. The rule involves a year-long bid by Mexico and Canada to overturn US labelling rules that require meat packers to identify where animals are born, raised and slaughtered. Livestock exporters in Mexico and Canada claim these discriminate against their cattle and pigs, forcing them to accept lower prices. The US has required country of origin labels on its beef, pork and other meat items since 2009. The ruling paves the way for Canada and Mexico to seek retaliatory action against the US. Earlier reports have suggested Canada could place import bans on US meat, wine, chocolate, jewellery and furniture. US cattle ranchers benefit because they receive a premium for their animals born in the US, and they're backed by consumer advocates who say Americans deserve to know where their food comes from. Canada and Mexico say the labelling requirements are discriminatory because meat packers don't want to go through the hassle and expense of segregating imported animals. As a result, meat packers pay lower prices for Canadian and Mexican animals. In 2014, the US imported more than 2 million head of cattle from Canada and Mexico and brought in nearly 5 million pigs from Canada. There's no evidence to suggest that the imported animals pose a health risk. The WTO says country of origin labels impose a disproportionate burden on producers and processors of livestock that cannot be explained by the need to provide origin information to consumers. To motorsport news, racing circuit entrepreneur Tony Quinn says he will spend another $25 million on further development at the Hampton Downs circuit he's just bought. The price he paid for the Te Kauwhata racecourse was $15.5 million. Mr. Quinn says he has a comprehensive development plan for scoping the market appetite for various property offerings. One of the founders of the track in 2003, Tony Roberts, told NBR Radio he's very pleased about the deal. He says, Tony has asked me to stay on and run the place after the deal settles on June 2nd. In the next 6 months, I expect him to inject quite a bit of capital. It will usher in a golden age for New Zealand motorsport. People are really positive about it. Mr. Roberts says it was a huge effort by himself and Chris Watson to build the track. He faced opposition from the Corrections Department, which has a nearby prison there, and Transit, which had various roading concerns. Mr. Roberts says if they hadn't delayed us so much, we would have got it built before the global financial crash. That set us back quite a bit. So Tony's entrance will see the fulfilment of a dream. The developments on the drawing board include a business park, which will see lots sold and or leased to industrial tenants. Hampton Downs holds about 28 major events, more than any other racing circuit, and attracts up to 30,000 people to its February 4-day festival of motor racing. The sale of Hampton Downs was less complicated than a deal involving Taupo Motorsport Park, where Mr. Quinn was rejected as a suitor by shareholders, many of whom are also members of the Taupo Car Club, which holds a lease agreement giving it use of the track for 14 days a year. Members of the Taupo Club thought they would lose their special position under Mr. Quinn's ownership, and other shareholders thought they would be unlikely to recoup their investment outlay from the $3.6 million Mr. Quinn was offering. The board of Taupo Motorsport Park commissioned Baileys to seek international tenders by the end of this month for the circuit, although commentators, including Mr. Quinn, doubt this will winkle out buyers prepared to pay off creditors as well as inject capital. Mr. Quinn says he remains in contact with Taupo Motorsport Parks Bank and the local council, which also has an interest. He said his bid remains live, but he won't take part in the tender process because he feels used and abused after attending a Taupo Motorsport Park shareholders meeting where he outlined his intentions. Motorsports aficionado and VIP pets owner Tony Quinn is Irish-born but has New Zealand nationality. He has property assets in several countries, including New Zealand, Australia and the US. His racing fame includes winning the New Zealand Targa Road Race Series 5 times. A major property development and racetrack investment he and his wife Christina own is the 88-hectare Highlands Motorsport Park property development at Cromwell, which boasts the best car museum in the country, go-karts and various family action experiences, as well as races. To those new house rules, Prime Minister John Key all but conceded that pressure from the Reserve Bank for concerted action on rampant Auckland house prices was one of the main catalysts for the government's weekend announcements about tightly applying tax law on trading and residential property. At his weekly post-cabinet press conference, Mr. Key said that while the government had been kicking around ideas for taking the heat out of what some believe is an emerging residential property bubble in the country's largest city, the decision to act was made about 4 or 5 weeks ago. That timing coincides with the April 16 speech by the Central Bank's Deputy Governor Grant Spencer entitled Action Needed on Housing Imbalances, and calling for focus on the tax-preferred status of residential property investment. That speech was widely interpreted as a call for a new capital gains tax, but the government was taking advice from the Inland Revenue and the Treasury by that stage on more tightly applying the existing provisions of the Income Tax Act, which treats the proceeds of trading in residential property as taxable income at the taxpayer's highest personal income tax rate. But Mr. Key said the government wasn't forced into action by the Reserve Bank Deputy Governor's comments. It's an ongoing thing. They dovetail in together, he said, to the Central Bank speech and its action in last week's Financial Stability Report to implement new, higher loan-to-valuation ratio lending restrictions brought inside the Auckland Council geographical boundary. Mr Key said the fact he gave the speech didn't make us go and do these things. I don't think that's the right order, but it's fair to say we've been having discussions with them and thinking about these things. In the end, what happened was that we got to the point where we said, look, we're either going to do something in the budget on housing or we're not. And if we're going to do it, we'd better get on with it. With final budget decisions required about a month ago and sustained price increases quite a bit faster than we would have liked, Mr Key said the government also started having discussions with the Reserve Bank about the speech. What would be some alternatives? They came up with the LVRs for investors. We thought this would add to and complement that, Mr Key said. He gave the impression the IRD was not a major supporter of introducing the new Bright Line test, which means proceeds from a property sold within 2 years of purchase will be treated as taxable income unless it's the family home, an inheritance or a sale caused by a relationship breakdown.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
In market news, Rubicon, the forestry biotech company spun out of Fletcher Challenge, has extended its financing arrangements with ANZ Bank New Zealand and issued US $7 million in notes to its major shareholder David Knott and its board members. The Auckland-based company's existing US $20 million debt facility with ANZ has been pushed out a year to July 1st, 2016 on essentially the same terms, it said in a statement. The extension allowed for Rubicon to issue up to US $10 million of unsecured debt notes, of which Knott took up US $5 million, while members of the board and management took up $2 million. The company did not expect to issue the remaining US $3 million, and the notes come due in January 2017. Chairman Steve Kasnet said, "We're very pleased that we've secured Rubicon's funding through fiscal 2016 and will believe that this announcement today should remove any overhang in our share price in that regard. Our focus remains solely on bringing value to our remaining Tenon and Arborgen investments. With this refinancing behind us, we can now do just that." Rubicon owns 2/3 of listed wood mouldings business Tenon and said it's mulling floating Arborgen after a failed attempt to list the biotech forestry company in 2011. Shares of Rubicon last traded at 31 cents, although they've fallen some 74% since their peak at 121 in March 2011. In People News, a mutual love of gardening discovered in prison has seen former Capital and Merchant Finance directors Wayne Leslie Douglas and Neil Medhurst Nichols granted parole after less than 3 years. But the pair's gardening leave from prison will include not being allowed to talk to one another, despite both intending to use their newfound green thumbs for work. Capital and Merchant owed $167 million to about 7,500 investors when it collapsed into receivership in 2007. Nichols and Douglas were both sentenced to more than 7.5 years imprisonment in August 2012 after being found guilty of fraud charges following what was described as one of the most complicated finance company trials seen in this country. These record-setting prison sentences were then increased to more than 8 years after they both pleaded guilty to further charges brought by the Financial Markets Authority. Decisions obtained by NBR say Douglas, 61, has been released from prison, while Nichols, 59, will be released this month after both were granted parole. They are less than 3 years into their respective prison terms. Douglas appeared before the parole board on April the 8th, where it was heard he's done well in prison. He's described as being compliant, friendly and polite with no misconduct. But it's his work in the Offender Employment Nursery and Horticultural Studies through an unknown provider for which he received the most praise. The decision says the dominating aspect of his sojourn in prison has been the discovery of a passion for gardening. He requires little supervision at work, puts in long hours and demonstrates high work standards. Douglas's release was granted to a 40-hectare farm at an undisclosed address with an unnamed woman. Nichols was first seen by the board in January, but it was discovered he was not actually due for parole until May, following confusion over when his sentence date began. He too had been working in the Offender Employment Nursery and has job offers within the industry. He was granted release on an unspecified date this month to a withheld address. FBT and public transport. Calls are being made by a transport commentator for the removal of fringe benefit tax on public transport. Transport blogger Matt Lowry says FBT on public transport is an active disincentive for employers to offer incentives such as monthly bus passes to employees. Employee car parks are FBT free, but if an employer were to buy a monthly bus pass or provide a subsidy for public transport for an employee, they would still have to pay FBT. Mr. Lowry says FBT, a tax on benefits employees receive as a result of their employment, should be removed from public transport to, at the very least, give employers more options. Mr. Lowry says in Los Angeles, if businesses offer a car park in an employment package, they're required to offer the equivalent value cash in hand, which encourages use of public transport. He says a similar initiative should be implemented in New Zealand. His comments come after a global survey revealed New Zealanders are spending on average 4% of their take-home pay on commuting. The discussion was sparked after an NBR poll revealed readers did not think it was reasonable for employers to pay employees commuting costs. Regis New Zealand and Australia Chief Executive Paul Migliorini told NBR that the high cost of transport is squeezing household incomes and employers should be doing more to consider flexible work options. Business New Zealand Employment Manager Paul Mackay says if FBT was abolished for public transport, there's no question that it would change behaviours. When FBT was implemented, it stopped employee benefits in its tracks. But he says it would still be a bit of a stretch to assume many employers will pay their employees commuting costs. Mr. Mackay says it would be rare, even without FBT, that the actual commuting was paid for by the employer. Where it's typically occurred is at the other end, the car park type arrangement. Asked to what degree employers should be responsible for employees' commuting costs, some 49% say not at all, with 22% saying employers should be entirely responsible and 29% saying it depends on the commuting distance.
NBR Radio with Hotel de Brett. Open for breakfast, lunch and dinner and everything in between. NBR Radio.
NBR Radio, Monday the 18th. I'm John Stewart. Gold is no longer capturing the headlines as it did 5 years ago. That's when it topped $1,800 US an ounce in September 2011. In his editor's insight on Monday, Neville Gibson says gold prices are making a comeback. Neville, just what is happening in the gold market?
Well, gold's one of those investments you buy to offset losses from inflation and store wealth at times when the future's a bit uncertain. It's been quite volatile since it reached that peak 5 years ago. In fact, it got up almost to $1,900 and then tumbled by well over $700 or $800 less than a year later. Since then, it's struggled to get back to that level, mainly because inflation has disappeared from many of the world economies, and those sort of prices are not going to recover all that fast. But there's just been a recent sign that prices are gradually improving and have done so far this year.
So where's the price now?
Well, the settlement price on Friday in New York, where they trade futures, was $20.25 an ounce, and that's the highest since it's been in mid-February when prices rose round about when the Greek thing was at a bit of a height. It tends to go up and down depending on whether there's a crisis, and there was when news of slowing growth in China started seeping through, and a lot of the emerging markets like Turkey were also showing quite a bit of a decline. So just tracking the price, it reached a bit of a peak in the middle of January at 1,300, and where it is now at 2025, it's still up 3.5 for the year.
So what actually drives the gold price?
Well, apart from concerns about the future of the global economy, the main price driver in the United States, at least, and that's where most of the gold trading takes place, is the timing of this interest rate increase that everyone's expecting from the US Federal Reserve. On Friday, they were reacting to figures that came out about the US wholesale prices. They slipped 0.4% in April. That's a huge amount, and most people were expecting inflation to be picking up a bit in America, so that was really against the trend in the market. So while gold in itself doesn't earn an income, it's actually, you've got to compare it with cash and other financial assets such as bonds. And when interest rates and inflation are about zero, people say, well, we'll buy gold, especially when it goes down just a little, then it ticks up again.
Now, in your editor's insight, you talk about a report. Can you tell me what that report is and what it shows?
Yes, John. The report comes out from the World Gold Council, and they measure what's going on over the quarter. They repeat what the record has been in demand and look forward a little bit. And it shows that global demand actually fell 1% in the first quarter up to March 31, and they attributed this to sort of pretty subdued buying, but consistency is not really a feature of the gold market. It changes quite a bit in different regions and in different sectors. For example, jewellery purchases around the world were down 3%, but the other form, which is bar and coin investments, these came under pressure in some areas where there were strong stock markets in India and China, for example. But in Europe, there was a huge surge, and in fact, sales of bars and coins, which are non-jewellery items, of course, saw a surge of 16%.
So where is most of the world's gold used?
Well, the two biggest users of gold are China and India. They purchase well over half of all the gold that's produced and also used for various purposes. There were two quite contrasting stories, though. In China, demand fell 7% during that quarter, and the Chinese New Year was a bit of a subdued period. Usually it's a big buying time, and the Chinese buyers tend to be quite price sensitive. If the price goes down, they pile in, and if it's up a little bit higher than normal, they keep out of the market. India is quite a contrast. Huge purchasing goes on there, but the thing that has really lifted the gold demand out of India has been the removal of government restrictions there. There's quite a bit of optimism about the Indian economy. It's got a pro-business government, and demand there rose 15%, with jewellery purchases alone rising 22%. They have a number of festivals there, and they had one in April, which was out of the period we're talking about. But that festival, funnily enough, is a time when you start up new ventures and hope for future prosperity, and buying gold is part of that.
Crystal ball time, Neville, but what is the future for
gold
prices?
I can only go by what the World Gold Council are always talking their book a bit, of course, and they say there's signs that the Chinese buyers are back in again. It might be that their recent activity has actually pushed the prices up a little bit, and why we're talking about it. And for the full year, they're looking at demand figures that will be around about 4,200 to 4,300 tonnes, but that's quite a bit up from last year, where it fell at just under 4,000 tonnes, and I think that will hold the price up till the end of the year, but look forward to quite a few changes in the price in the meantime.
Neville, thanks for your time today.
NBR Radio. Free to air online with business news you can use.